Hello Sector Watchers, welcome to this 13th episode of Sector Spotlight on Tuesday the 31st of December. This is your weekly update on sector rotation and anything remotely connected to sectors, relative strength and/or rotational analysis. My name is Julius the Kempenaer and I am your host for today's show. This show is recorded, so no interactive chat today, but feel free to reach out or respond via email or social media. And as usual, I will try to respond to every message. Ladies and gentlemen, this is Sector Spotlight. As this is a recorded show, I did not want to make it too time sensitive. So for today's agenda, I will start with looking at seasonality in general. Then we'll dive into how you can combine the seasonality tool with the RRG tool. We'll have a break as usual, and then after the break I will show you how I graph all seasonalities for all sectors in one graph and then combine that with RRG. Let's start with basic seasonality. If you go to the top of your page on StockCharts.com, you will see in the drop down here that seasonality is one of the options as a charting format. Let's start with putting in the S&P 500, so $SPX. What I will do is I will give you this picture, but for the educational, the explanation part of this show, I will start with clicking on the icon on the bottom left corner, which says separate. And what it actually does, it's showing you the performance of the S&P 500 over a number of years. So the default is 5 years, and you will see 2015 until 2019. So if we tick that off, then you'll see that 2019 is gone. That still has a little bit more to go. We could do that with every other year. Now 5 years is not too much, so I'd like to stretch this out to its maximum, which is 20 years. And then you will see the performance of the S&P 500 in each and every of these years. If we switch to the next icon, which puts all these performances on the same scale and expresses it in percentages, you get a better idea, you get a better picture. And again, easy, the 2019 is the top year here, so it's been a very, very good year. Tick it off and it will go, and so it's a toggle, it comes back and it goes. What you'll see here is that in general we've had a pretty good run over these years, and you have a couple of very bad years with -40 and -25, etc. You can look up which year it is in the table above. Eventually, and that's what I think is the most powerful visualization here, is when you put it into a histogram. And what this will show you is the percentage of months in which the S&P 500 closed higher than it opened over the last 20 years. And this gives you a good picture and a good feel of how the S&P 500 behaves itself throughout a year. So in January it's about 50-50, and then it goes up until April, and in every April over the last 20 years, 75% of the months the S&P closed higher than it opened. So that's a pretty powerful metric, and the same goes for November. So these are traditionally pretty good years for the S&P 500. That's powerful information. And I can also do that for a sector. Let's say, I don't know, XLK, technology, always a nice guinea pig for this kind of stuff. Again, we can do that on separate scales. So here is 20 years of technology pricing. We can put them all on the same scale, and then you'll get pretty much the same as what we had for the S&P 500, so every individual year. And then we can get it in a histogram format, and you'll see that there are now differences here. None of the months is above 70%, so November is the strongest, just like the S&P 500. But if you see that in April it was only, but still way above 50%, 65% in which XLK closed higher than it opened. And we can do that for each and every month. Here is staples. Again, let's drag it out to 20 years. And you'll see that March, traditionally, and again November, is a pretty good month. Now, this is giving you absolute price terms. Oh, by the way, the numbers in the bottom here, in the bottom of each histogram, each bar, is the actual performance of the sector in that month. So in March, 70% of the months over the last 20 years, consumer staples closed higher than it opened, and the average performance, the average return in the month of March for this sector was 1.3%. That is how you read this chart. The next step, because I'm going to tie this to the use of relative rotation graphs, and they are all about relative strength and all about outperformance and underperformance. And that's where the second box on this page comes into play, because I can compare the performance of a sector to something else. Now let's stick with XLP and compare it to dollar SPX or SPY, doesn't really matter, and run it again. Drag it to 20 years and you will get a different picture, because what it's showing you now is the percentage, the number of months in which XLP outperformed the S&P 500 over the last 20 years. So there you see that the strongest month in terms of outperformance for the consumer staples sector is the month of September. 60% of the cases over the last 20 years, staples outperformed the S&P 500 in the month of September, and the average outperformance was 1.2%. Now let's try that with the other sector that we used in the previous example, which is technology. Do that again, and then we'll see how that goes, and you'll see a different image. And you'll see that August and October are actually the strongest months for the technology sector. So in August, in 70% of the cases, XLK outperformed the S&P 500 with an average of 0.6%. The same happened in October. 70% of the cases, the technology sector outperformed the S&P 500, but the average outperformance was 1.8%, so significantly higher. Now, as you know, there is no holy grail in trading or investing. And for me, it's all about combining tools. I see them as pieces of the puzzle, pieces of the financial puzzle that we're trying to solve every day. And our technical toolkit is filled with a whole lot of different tools that we can use for different purposes. But I think the real strength comes when you combine the various tools to build a picture, build a scenario, get a sense of what's going on in the market. Now, obviously the seasonality tool is a tool that can give you guidance and some idea of a likely path that the market could take. How do I do that with seasonality and my tool, RRGs, relative rotation graphs? In order to do that, I want to put them next to each other. So we've got the seasonality tool here. Now let's open a second window and create an RRG, and then we're gonna quickly put these next to each other on the screen, and we now have the 20-year seasonality of technology on the left hand side, and I'm going to load up the RRG for the S&P 500 sectors on the right. With this setup, I can now look on my RRG what is happening right now in the market, and I can see on the left hand side the seasonality of a specific sector and how it has behaved in the past, and if there are any odds or likelihood that that kind of outperformance could happen again. Now, let's look at the healthcare sector, because that is right now one of the better sectors in the S&P 500. So in order to do that, I load up the seasonality of the healthcare sector versus the S&P 500, because the S&P 500 SPY is my benchmark here. Stretch it up to 20 years, and what I see is that January in general over the last 20 years has performed very well, has outperformed the S&P 500 in 70% of the cases. And the average outperformance was 1.4%. Now, that gives me a little bit of backing, a little bit more ground, and if you want, reliability, a push in the back to believe, to go with the relative trend that we see displayed on the RRG, that shows a strong relative trend for healthcare going into the new year, going into January. And that move is backed by a strong month of January for healthcare with a strong outperformance. So that gives me a little bit more confidence to make a call that I think that healthcare will be one of the better sectors in the first month, maybe few months of 2020. February and March don't look that well, so if you may call it fantasy, call it, I don't know, combining the two, you might think, or you might come up with a scenario saying that healthcare is likely to do pretty good in January, following this rotational path here, and maybe, and that's just a big maybe because I'm just trying to combine a few things here, roll over and lose strength, because February and March are notoriously weak months for the healthcare sector. There's no certainty in it, but this can help you paint a picture. Now, I do think that you should always take the actual picture, so in this case the RRG, as the lead, because this is what is actually happening right now, and this is what has happened in the past, and we're trying to make that into some sort of statistical guideline. So RRG, or if you want to work with price or anything else, that's also fine. But the actual chart, what's happening right now, that should be leading, and you can get a backup, you can get some more confidence from a strong or maybe a weak seasonality. Now let's do the same for technology. So we got technology here, and we do that over 20 years, and there's also a pretty good, not 70 but 65% of the months over the last 20 years, technology has outperformed the S&P 500 by 0.6%, and then it drops off, just like healthcare. February, March, April have not been the best months for the technology sector. So this is how you can actually combine these two. Let's do one the other way around and look at, let's say XLY here, discretionary. Let's see how that behaves. 55, not the best. So weak relative strength. This is like a coin toss, so not fantastic, not very usable. But looking forward, it looks as if February, March, maybe even April tend to be pretty good months for discretionary. And if we combine that with the RRG, then let's just fantasize a little bit and see if we may track this discretionary tail curling up in the next couple of weeks. First weeks in January, not very strong, but if January is the turnaround, then maybe in February and March we might see a strong discretionary sector. Again, no guarantee here, this is just fantasizing, looking ahead, but trying to explain how you can combine seasonality numbers with tails that are actually underway right now on the RRG. We're going to a quick break now, and after the break I will continue to expand on combining seasonality with RRGs, especially using another way or an extended way of visualizing this seasonality in combination with RRGs. So stay tuned and we'll be back after the break. Welcome back, and as I promised before the break, I am now going to expand a little bit on the visualization of this seasonality in combination with RRGs. This setup as we have it here right now is super powerful as it is. We got the RRG on the right and we got seasonality on the left. The only thing is that for every sector I need to bring up the seasonality separately. So right now I can look at discretionary and combine it with what I'm seeing on the RRG. If I want to see another sector, let's say staples, then I got to bring up staples, extend the range, and combine it with what I see on the RRG. Now, one of the most powerful characteristics of an RRG is that it shows you all the relationships that exist inside a universe in one image. And what I wanted to do is see if I could get a similar view for seasonality. So I started to play around. And I've actually written 2 articles on this subject in the last few weeks. So if you go to, the one was in the DITC blog that I write every Thursday, and it's actually here. The title is "When you enter 288 numbers, this is what you get." And the second, a little bit more extensive article was published on the same week in the Chart Watchers newsletter. And that is the one that's called Slicing and Dicing Seasonality. Now, you may have read it, you may have seen it, but what I want to do here is actually show you how I did that. And in order to do that, I've got to bring up my Excel sheet. Let me position that on the right hand side. I prepped it so we don't have to do it all during the show, but I'm going to show you the workflow and how it's done. So we got to go to seasonality, and what you see here is that the first top part of the sheet is seasonality. This is where the seasonality numbers are coming in for SPY, and then all the sectors and the various months. So the way you do that is actually pretty simple. Let's forget SPY, because SPY is only there for reference purposes. I'm not going to use it later on because what I'm using are the relative performance numbers. So all of this is relative. It's not the absolute price performance as I showed you in the first half of the show. This is all based on relatives. So let's bring in XLB seasonality versus, and I'm now going to use SPY because that's what I used in this spreadsheet, and bring it in 20 years. So what you'll see here is that I've entered in this column these numbers. So in January, XLB 40%, then February 55, 50, 55, 30, and so forth until 70% in November and 55. Now in the column below, you will find the performance numbers. So in January, minus 1.1, as you can see here. In February, 1.4, 0.2, and then 1.5 and 1 in November and December. And if we bring in XLE, you will see the same. So XLE is here. We have 45 and 45 in January, February, 60, 60, 40, etc. to 35 and 60 in the last 2 months. And again, we'll have the performance, the outperformance numbers, 0.5%, 1.1, 0.5, and then minus 0.8 and 0.8 at the end, and so forth. So that is how this whole spreadsheet is built up. So these are my raw numbers. These are the months that the sectors are outperforming S&P 500, and this is the average performance number. Now, how do you get from this table to a meaningful chart? So what you do is you select the whole universe, and you're gonna insert a chart. And I wanted to look at columns. So I select the columns or bar charts, and when you hover over it, Excel will show you the various options or how that universe would look. And what triggered me was this visualization, the 3D column. And you can see that I get now already a little bit of a sense what's going on. The only issue is that my sectors are on the horizontal axis and the months are on the X, Y, and then Z, so the Y axis. And I'd like to see them the other way around. Now, the simple way to do that is you clicked select data and you switch rows and columns, and there you go. Now you have the months and you have the various sectors going that way, and that will actually help you. You can tailor this chart, give it colors, change it any way you like it. I'm just doing this here to give you a quick idea on how you can bring up that chart. Let's delete it right here, and you can do the same with the performance numbers. I'm going to insert a 3D chart, and I have that now here, and you can see, because this also has negative numbers, you can see that the split is some sort of a floor here where you can see numbers going downward. And if you hover over each of the columns, you can see that this is the series February for the financial sector, and the value, so the outperformance at that time, is minus 1.3. And you got that for all sectors and all months. Again, you can tailor this, and you can make colors, and you can do anything you like with it. And I've already done that work, so what I've done here, I'm going to bring up my chart that I used in the articles, which shows you the seasonality of outperformance versus SPY. So these are the percentages that these months are outperforming versus SPY. And I've added the table below. That's a function that is in Excel. There's nothing, you don't have to type that in, you can just do that. And here you got all the sectors. And as you can see, I have omitted SPY because I am looking at these sectors versus SPY. So these numbers are already relative versus SPY. Now the cool thing is that you can actually use this filter, and you can see that I've ticked off SPY, so nothing will show up. But when I select one, now I can see the materials sector highlighted on my screen, and I still see in a dimmed format all the others, and I can relate the seasonality of materials versus all the others in one image, which I'm not able to do when I'm just printing them off or looking at them one by one. So it's similar with RRGs. RRGs are bringing you relative charts in one picture, and if you do it like this will bring you seasonality in one picture of all the sectors. And I can actually highlight, now I've got communication services, I've got energy, I've got financials, I got industrials, and you can see how different they behave. Like, you know, you got financials here, which is pretty good in December, pretty good start in January, and then you got industrials, which is super strong in November and not so strong in January or February. So this way of bringing these data to life gives me an extra option to get a better view of what's going on in terms of seasonality in this universe of US sectors. So the only two that I am I would be very careful with this is real estate and communication services, because they have, as you know, they have been added to the universe not too long ago, so they have limited data. So the rest is all based on 20 years of data. Real estate and communication services have less data, so that's why I am sort of reluctant to use these too much, because they're based on a lot less observations. Now I can actually bring that here and I can walk through all these various sectors. And that gives me a pretty good clue about how this universe, how these sectors behave themselves throughout a year from a seasonality point of view. Not only can I do that with the various sectors, but I can also do that with the various months. So I can go into the table from the other axis and highlight the seasonality for all months during 1 month. So here you have highlight the relative performance seasonality for the month of January for all sectors. And you can see that the high histogram, the high column at the end, is actually the healthcare sector at 70%. And I can do the same with February, and then you can see that it is actually discretionary at 70%, which is the one that stands out. So with this, I can actually immediately see in a particular month which sector or sectors are standing out from all the others, or maybe they're all the same. But it gives me a pretty good clue and an expectation of what I can expect from the various sectors in a specific month. Now, the same thing I can do, of course, with the performance numbers that we entered. Again, you select the filter option and I can see the seasonal performances, out or underperformance per sector, with the positive numbers sticking up and the negative numbers going down from that floor at 0. And here also I can go into that table, into that graph from the other side and see the numbers on a monthly basis per now for all sectors. Now look at this. This is the month of March, and there is that big number for real estate. As I said, that's a little bit debatable because it has less data, but it stands out. So just wanted to give you this way of looking at stuff. If you're interested in the spreadsheet, you don't want to type in all these numbers, please drop me an email and I'll be happy to share this, this spreadsheet with you. And I quickly want to finalize this show with bringing this spreadsheet to the left-hand side. Let's bring out the months here and combine it with my RRG, and now I can do the same as what I did with the single chart, but now look at all the individual sectors combined with the seasonality of all the other sectors plotted around it, so I can get the big picture in seasonality together with the big picture in relative rotation. This was the 13th episode of Sector Spotlight. Thank you for watching, and please don't be a stranger and stay in touch. As this is the last day of the year, I would like to wish all of you a very happy new year with great trades and investments. In 2020, Sector Spotlight will continue to air every Tuesday from 10:30 to 11 a.m. Eastern. Meanwhile, if you want to read more about sectors and RRGs, please go to the RRG blog on StockCharts.com, or even better, subscribe using the link below each article to make sure you will receive a nudge every time that a new article is posted. See you next year, see you next week.